There. This is Brian Zieg from Surf City Financial Group. I am the founder and CEO, and I want to thank you for logging into this. As you say, attending this seminar, because quite often we do this live, which I enjoy because I get a lot of good questions and feedback, and get to talk to a lot of nice people, so it's a lot of fun. But the title of this is Social Security Maximization. So, and we're definitely being on that. But first, let me show you something here. See this? This is a dollar, right? You know what this dollar represents? This dollar represents all your retirement dollars, including your Social Security. Now, some of the things you have to think about this dollar is what happens to your savings, right, in retirement. Well, first of all, there's taxes. That's going to take a piece of that dollar. I don't rip it up because I like my dollar. So, first you got that to deal with. Then you might have some inflation. So that's going to take a little bit more of it, right? So, and then you might have healthcare issues. That's going to take a little bit more. Then you might have you might have some stock market corrections. That could take a little bit more, right? Then who knows, the kids might move back in with you, which might take a little bit more. So you're basically left with this. You got to make this last your whole life once you go into the retirement years. So that's tough. And so that's something, and because we're going to be talking about that a little bit in regards to that. You'll see what I'm talking about once we get into this. But really important stuff to know about as far as the impact of outside forces on your retirement dollars. So, but let's get started here. Okay, first let's go over our agenda here. First thing we're going to talk about is Social Security basics. That's basically how you claim, the ages you can claim, who can claim, things like that. We're definitely be going into that and showing you a little bit about that, basically the basics of it. We're going to talk about different claiming options. Because they're with couples in particular, there's over 500 different ways to take Social Security, and there's different situations for different people as well too. Widowers, divorcees, all this stuff we're going to touch on a little bit. And then Social Security Maximization strategy, that's going to be a big one. We're going to talk a lot about that, how you can get the most out of this benefit and how it impacts the rest of your world and how important it really is. So you really want to maximize this. We're going to show you a couple real life case scenarios. One is kind of a typical one, and the other one, there's not a lot of people can still do it, but there's people who take advantage of it, so we wanted to show it. Retirement tax updates and strategies around that, because from a little demonstration there, taxes could be the second or first or second largest expense you're going to have in retirement, and it can absolutely, your Social Security can be taxed depending on your other assets. We're going to talk about how we create a custom retirement plan for you. We not only do a report for you, with your own custom report of your best strategy for getting the most Social Security, but we also do a retirement income shortfall program, which is kind of proprietary for us, and we've developed this with our team over the years. It really will show you your income shortfall analysis, and we're going to show you how we can actually create a custom retirement plan for you, and ways you can actually develop income in retirement too. So we're going to get into all that. This is kind of our initial thoughts, more or less our disclaimer, talking about blah blah blah. This is not. We're not intending to give individual advice here today, which we obviously can't. But we do think this is still incredibly useful for you, to give you some thought process. Well, one of the things that happens, because many people believe when you enter retirement, you walk into Social Security and they're going to tell you the best time to take it. Well, the truth is they can't really give you that advice. Number one, they're not trained for it. Number one, there's no way they can have all the information to do this. And I might add, they're really not allowed to give that kind of advice, again, because they're not trained for it. So this is a significant problem because there's a lot of information out there, and you've got to be careful of where you get it from. So, and I'll get into that a little bit more too, because the significance of Social Security is amazing when you look at it. So you're seeing here, it could be up to 40% of the average income earners or more of their retirement benefit. So it's huge. You can see here, if you're making $60,000 or more, it's likely 30 for the average person out there. It's 40% of their total retirement income. So you need to really make this decision properly. And as you see by the chart, it's still the basic foundation of most people's retirement income, with 86% of seniors 65 and older reporting they are utilizing it as one of their most important retirement sources, followed by assets, income, and employment. So it's a big deal. Now, the other problem is people become frustrated and confused when it comes time to make this important decision. The sheer amount of information can be overwhelming. And what I started to say earlier is you get information from the financial entertainers out there, as I call them, but I don't view them as good sorts, because you can't do retirement planning in a 15-minute phone call. I wish it was that easy, but it's not. And I think there's sometimes biases with some of these financial entertainers. Now, the other thing I talk about is the water cooler advisor. That's the person you may think a lot of, may be friends with, may think they're really smart, and they very likely are, but they may be working off of bad information or based off of their experiences, which I might add, their experiences might not even be correct. So it's important to find someone who's going to give you an unbiased view, and we like to think of ourselves that, because why wouldn't we give you an unbiased view? So it's really important. And so I think you really want to seek out good advice for this, because the truth is there are more than 500 different ways for a married couple to file for Social Security. And choosing the right option could mean the difference of potentially hundreds of thousands of dollars, as you see in some of our examples, actually. Now, complimentary, we will be offering you a way to get a complimentary appointment with us. Because this workshop is purely education, and however, in order to take full advantage of the information and resources we're going to provide you today, we're going to offer this with no obligation, and during this appointment we'll cover the topics you specifically request. These topics include having us run a Social Security Maximization Report that calculates the single best way to maximize your benefits. But remember that Social Security is only part of your total retirement income requirement, and we can discuss and create an entire plan to create a predictable income addition to Social Security. Lastly, we can discuss either safe, money, or tax-free strategies. We want everyone to walk away from this presentation feeling more confident about choices that they have when claiming Social Security and their overall retirement plan. So I would advise, I'd encourage you to take advantage of this. So we like doing this, and we're happy to do it. Now, who's eligible for Social Security? Now, if a worker's accumulated up to 10 years, they're basically going to get 40 work credits. So basically all what you need is 40 work credits. And also the benefits are based on the highest 35 years of earnings. So let's say you've been a stay-at-home person, or you started earning a lot of money later in life. You might have just reached levels where that's going to boost up your retirement. And I've seen cases where if you've been a stay-at-home spouse and now you may re-enter the workforce when the kids are grown, or at least back in school, in the college or whatever, they're now making a lot more money. So that's definitely going to increase the amount of Social Security you're going to get. So, and if you have some zeros in the past, those later years of working could potentially boost up your Social Security benefit quite a bit. Included in that is a spouse. They're married for 10 years to a spouse. If you've been married to a spouse who's also eligible, done it 10 years, you too, even though you may not have the credits, you will be eligible for Social Security as well. Now, who can claim? Now, or when can you claim, I should say. The benefits are on the age when you claim. So the earliest you can claim Social Security is age 62 for your own benefit. The latest you can claim is age 70. So you don't want to go past 70, but that is the latest you can claim, because if you go past 70, you're not gaining anything, and you'll see why there's big differences on when you claim. Now the hinge point is that FRA you're seeing there, full retirement age. This is a really important concept, because like I said, a lot goes into that. And currently full retirement is anywhere between age 66 and 67. And you'll see what I'm talking about here in a moment. How can you claim? Well, you basically go to www.ssa.gov/myaccount and you develop an account, which will give you this report. Now, some of you probably remember receiving this in the mail. Well, they don't do that anymore. I think some get mailed out on certain milestone years, maybe. But for the most part, you really don't get this report. So you just go online and download it, or just look at it. Now, we have a template built out for this. So if any of you need information on how to do this, we help people develop an account, because I think it's important. Because, well, we need to do it if we're going to do some planning for you. We need your information, and if you're married, your spouse's information as well. And you can register you can go do that right now. No. Now, claiming age really affects your monthly benefits. So age 62, monthly benefits will reduce by 25 to 30% depending on your year of birth, because at your full retirement age, you're entitled to 100% of your full benefit. Now, again, if you reach full retirement, if you're 66 or 60, somewhere in between 66 and 67, and you hit full retirement, you will get 100% of your benefits. And if you wait, your benefits could increase up to 132% of that full benefit. So important things to keep in mind. I think it's probably start becoming clear to you why there's differences. Now, here's how the claiming age affects your benefits. As you're seeing here, if your full retirement age happens to be 66 and you take it to 62, your benefits permanently reduced by 25%, which I'm going to point out also reduces a COLA, because even if you get 2% COLA, obviously the bigger your benefit, the bigger your COLA is going to be, because it's a percentage-based COLA. And so you're seeing there. And now if you wait till if your claiming age, if your full retirement age is 67, you take it early, it's reduced by a full 30%. So it really depends in there, but you see the different ages where you'll age in based on the year you were born, right there. You see, for instance, if you were born in 1958, your full retirement is 66, age 66 and 8 months, and if you take it to 62, your benefits reduced by 28.3%. Now, here's a Social Security benefit example. If you're looking at this, you're seeing that if your full retirement age is 66 and your benefits 2,000, and you claim early, your benefits only going to only be 1,500. If you wait, your benefits going to be 2,640. And keep in mind that COLA thing I was talking about. And what you're noticing there, as you defer, there's 8% increases every year defer. There's not and that's guaranteed. There's not a financial vehicle in the world other than Social Security where the payout, now don't confuse rate of return with payout. Payout's a big deal. So if you're waiting, you're getting an 8% increase in your payout as you're seeing by the numbers. If, in other words, wait to 67, your payout goes up to 2160. Again, those COLAs will be bigger as well too. So important concept. Now what you're seeing here, what this means is by simply deferring your Social Security past age 62, you'll be able to receive a substantial increase in the total amount of income you'll receive. In this example, a person who claimed at 62 will receive a total benefit $864,608 if they make it to age 95. If the same person were to wait to age 70 to start income, they'd receive over 1.2 million, which is an increase of over $385,000 of income completely guaranteed. Now, this might seem like an obvious and simple solution to create income, but more than 50% of retirees file for Social Security at age 62 and thus forego this increase in retirement income. That's huge. And a lot of people do this for different reasons. Health sometimes will force them to do it, and sometimes people haven't saved enough money, so they end up having to take it. Which is rather unfortunate. But some people actually believe Social Security may be going away, or they just take it because it's there. I've seen it. I've heard them say that. And I might add, they do the math all wrong. And I see this all the time. I can't tell you how many people come to my office and they're 65, 66 years old, and they've already taken their Social Security, and I'm just like heartbroken what they've left on the table. But it's really important to pay attention to this because you see the difference. So again, well, the other thing I'll say, a lot of people think it's going away, but I find that hard to believe if you think about it, because it's been here a long time. And the other thing is, well, first of all, if you're talking political, I remember when George Bush just wanted to privatize it, people hit the streets and got really, his idea got less popular as more people heard about it. And the other thing is, more than half of seniors would go into poverty immediately if something happened to Social Security. And there's some other demographic things that I think are actually going to work in Social Security's favor. And there's adjustments they can make. We've made adjustments in the past, so I don't see this going anywhere. Now, working in retirement, another big thing. I've seen people take their benefit while they're working, not looking, again, not either doing the math or not really doing any research. Because of course, because sometimes downturns, whatever, but I get it that sometimes you just need the money and you have no other choices, but look into any possibility, because this is such a valuable asset. Because you're seeing here, for 2019, if you claim your Social Security between age 62 and remember that full retirement age, your benefits will reduce by $1 for every $2 above that $17,640. So here's an example for you. If you earn $22,640, $5,000 over the limit, your benefit's going to be reduced by $2,500. Why give up all that money if you don't have to? So, because that's going to add up over time too. There's a lot of opportunity costs there. Now, how is Social Security taxed? Now, depending on your combined or what they call provisional income. It's combined. It's a combined of your adjusted gross income, any tax-exempt interest you've earned, and 50% of your Social Security benefits that you've earned. So, if you're getting a $2,000 benefit, $1,000 of that is going to go toward that provisional income. And the other thing I point out is a lot of people have like muni bonds thinking it's going to be tax-free. Well, muni bonds are considered provisional income. So do know that there's other tax-free things out there that you can actually won't count as provisional income. We'll talk about that in a minute. And you're seeing here that, basically there's two levels, 50% depending on how much you make, and 85% of your Social Security is going to be taxed depending on that provisional income. And you're seeing some numbers here, but let me show you a little bit here. So you're seeing that if you're under $32,000 for joint filers or $25,000 for single filers of provisional income, you will know your Social Security to be taxed. Now, you're seeing that if you're between 32 and 44 or 25 and 34 for single filers, 50%, and over 44 or 34, full 85% of your Social Security will be taxed at whatever tax rate you happen to be at. So there's ways to do this to keep that down if at all possible. Starting early is a good idea to start planning, which I do for people. So important to know. Now, as a result of 2016 tax change, the 2015 bipartisan budget bill, November 2nd, 2015, they did eliminate what was called the file and suspended and restricted application strategy, which I was really bummed to see. That kind of bummed me out because it really affected a lot of middle income people greatly. So if you weren't able to take advantage of the file and suspend, that went away on the 2016. Now, restricted applications, if you did turn, and I'm going to show you an example of that, if you turned 62 before January 1st, 2016, you can still do a restricted application, and I'll show you the benefits of that too. Now, Social Security Maximization. Now that you have a bit of an understanding or a clear understanding about the basis of Social Security, when you can claim, let's go into actual strategies. Now, spousal benefit. A spouse must be 62 or older to qualify for a spousal benefit. Worker must file for their Social Security benefits. Now, if a spousal benefits are claimed at the spouse's full retirement age, the spousal benefit is 1/2 of the spouse's primary insurance benefit, what they call a PIA, paid in amount. Now, spousal benefits are permanently reduced if claimed prior to full retirement age. So another thing to remember. But the important takeaway on that is a spousal benefit will typically have filed at full retirement age, no matter what their benefit was or wasn't, they will get at least half of what the higher earner spouse is going to get. So important concept to understand. Now, spousal benefits and divorce. Now, a divorced spouse, an ex-spouse can get Social Security benefits based on the other spouse's record if the marriage lasts at least 10 years. Now, the benefit that the receiving person is entitled to is based on his or her own work is less than the benefit based on divorce. In other words, if your benefit's larger than taking the divorce spousal benefit, then you're going to take your own. But if it happens to be smaller, and we're actually working on a case right now, we had a stay-at-home spouse, and they got divorced, and the stay-at-home spouse or ex-spouse at this point was married to a high-income earner. So we're able to go in with just this divorce decree and the Social Security number and get that ex-spouse's benefit for them. So they'll get half of the other spouse's benefit, even though their benefit is next to nothing really. They didn't have much of a benefit at that point because they didn't work. They got 10 years in, but they had a lot of zeros because they were a stay-at-home spouse. So we're actually able to go in, and it doesn't affect the other spouses, divorced spouses. They don't even have to know about it. So, and we can actually do that. Now, other Social Security topics. There are. Let me look at something I have. I want to talk about survivor benefits. I kind of missed that one. Now, a surviving spouse is able to receive, and we're actually working on that too, for a couple people. If you receive benefits, you can receive a widower based on your age at any time between 60 and your full retirement age as a survivor. However, you start at an earlier age, your survivor benefits are reduced a fraction of a percentage for each month before you reach your full retirement age. If you receive a widow or widower with benefits and you will qualify for a retirement benefit that's more than your survivor benefits, you can switch over to your own retirement benefit as early as 62. So you could actually take a survivorship benefit for a while and then switch to your own when it gets to full retirement age. So it's kind of a handy thing. Now, other topics, there are many factors not discussed in dealing with Social Security. Some include if you work for federal, state, or local government agency, like a teacher, there's windfall things and things like that, survivor benefit. A lot of this stuff can be affected. There's primary insurance amount calculations, cost of living adjustments you'll receive, and disability benefits. So Social Security, there's a lot of things in there. We're not going to get into everything today because we'd be here for hours. But we can address those if that happens to be your situation, any of those things. Let's go in those real life case scenarios. Now, here's client one, and this is their summary. And you're seeing that's David and Julie, born in 1256 and 858. The current age of 62 and 61, so we're getting there now. Life expectancy, age 85 and 90. An annual salary of $73,600 and $60,000. Full retirement age, 66 and 4 months, you can see by his birth date. And Julie's 66 and 8 months, again. And we're adding a 2% inflation on this thing. Now, what we recommended for them is David files for his benefit at age 70, and Julie begins taking her benefit at age 70 as well. Lastly, because of that life expectancy, seeing there, David is 85 and Julie's is 90. So, and she's younger, so we have many years after David's life expectancy to get through. So this is what we recommended. So let's look at how it worked out, how it will work out if their life expectancy is sort of what we're figuring on. And we're seeing if both take benefits at age 62, they would have received a little over $1.1 million. If they both take it at their full retirement ages, they would receive almost $1.3 million. A nice chunk of change, right? Now, if they wait till 70, which is basically our recommended strategy, they would receive over $1.4 million. So that's quite a bit of difference. And that difference is almost a 30% increase, a 29% increase by deferring out their Social Security. And I might add, they have other assets, so we're able to actually use those other assets. But later on, it's going to really help stretch those assets out, and we've built some income for them and things like that. So they're going to have a nice, successful retirement. But you look at the difference in the amount of benefit they'll receive from Social Security is huge. Now, next one is kind of that one that is still available for Ryan and Heather. And you're seeing, because of his birth date, 1953, and hers is 1956. And he's now at 66. So he's reached his full retirement age. Heather's 63. And again, life expectancy 78 and 95, 90,000 and 45,000. You see Ryan, full retirement 66, and Heather 66 and 4 months. Again, 2% COLA. Now, how'd this work out? And what we recommended, we're going to have Heather actually in this case take her benefit at age 62, and Ryan is going to file that restricted application at age 66. And he can still do this since he's now 62. And Ryan switches to his Bennett was 62. Ryan switches to his benefit at age 70. Lastly, Heather will receive a survivorship benefit. Now let's see how this works out for them. Now, we're seeing that if they did what half of America does, they're going to get a little over $1 million. Not it's still a good sum of money. But if they'd take a full retirement, they'd receive 1.2. Now, both take their benefit at age 70, still even more, almost 1.4. But by following our suggested strategy, they're going to get over $1.4 million, which in this case is a 36% increase than if they'd done what half of America does, or more than half America does. So that's a substantial difference in lifestyle they're going to have. So that's a big deal. Now, maximize your Social Security. Remember that Social Security will potentially be your largest single source of income in retirement and could potentially receive hundreds of thousands of dollars next to retirement by choosing the right claiming option, as you're seeing here. Now, there are free resources out there for you to do calculations. Now, just because a calculator tells you something doesn't mean that's necessarily the way to go. So you kind of owe it to yourself to get some help on this and figure out what's best for you. Now, we're going to go over a little important tax updates, but first thing you're going to want to know is kind of top marginal tax rate history. As you're seeing here, top marginal tax rates has changed a lot. They've been as high as 94, and right now, the top tax rate is less than 40%. So big difference. Now, the average tax rate over history is 57.5. Now, got to ask your question, is it ever going to go up or down? And I ask that question, I rarely get it down. As a matter of fact, I don't think I ever get it down unless they think they're just not going to have any money. Now, understanding how this works, let me give you a couple examples here. If you look at back after Great Depression and World War II and all that, we're creating a lot of jobs. The government's putting little jobs programs together. We're digging out of recession, all that. We're paying for a very costly war. So at one point, the top tax bracket was 94%, but you had to make $5 million to get into that, which was a lot of money back then. But what they did is to cast a wider net, they dropped that top bracket down to 300,000. Now, there wasn't a lot of people making 300,000, but there was a lot more than making 5 million. So, and the other one I'll point out is during the 80s, we dropped the top tax bracket down to about 28%, and you only had to make 30,000 to get into it. Now think about that for a moment. What if you're putting your money away during the 80s when we had that low bracket and you were making, let's say, making $80,000, $90,000, and then you were retiring and you'd saved a lot of money and everything else, and you're getting your pension maybe, and then next thing you know, the top tax bracket went back up to 40-some%, or went up to 40%. That's a big out. So, and the next thing I'm going to show you is gonna show you what I'm talking about and how you can kind of maybe avoid those messes. Because there's 3 buckets of money. Now, there's a million different tax investment vehicles out there. You think about it, there's lots of them. I mean, mutual funds, stocks, bonds, annuities, life insurance, CDs. You can go on and on and on. But there's only 3 places you can actually put your money, and what is actually taxed, falls into different brackets. So first of all, you have your taxable bucket. That's those dollars as it grows. Think CDs or even investment accounts. As like CDs grow, if you're making 2%, you're going to get taxed on that 2%. So meaning that growth is not so great after all, because you got taxed on that 2%. And the same thing with an investment account. If you got an investment account, say you have dividend paying stocks in there, or you've sold something off, you take the money to buy something else, or you reinvest to see those dividends. Well, that's going to be taxed. I don't care if you reinvest it or not. So that we talk about is your least efficient one. Then your tax deferred, or what we call tax postponed, because the tax calculation tax postponed too, but we do find is more efficient because at least you can kind of control how much of that, for the most part, you can take out. So, and that's your 401ks, IRAs, things like that, 403bs, all that, any qualified plan. And as your tax-free, that's your 529 plans, Roth IRAs, and life insurance. Now, 529s kind of don't count because you can't use them for retirement. And I talk about them. I'm talking about college planning. I don't find to be all that, but that's another story. So Roth IRAs, Roth 401ks, and life insurance are your tax-free vehicles. Now, here's your income tax changes. You're seeing that, the brackets there, it's kind of a mixed bag if you look at it. Depending if you're single filer, joint filer, but we'll get into a few other things that have created some actual tax increases for some people, even though some of the rates went down. Now, because limits on state local tax deductions, so they've reduced that to $10,000. Now, there was an increase in child tax credits, but if you're tired, that's not going to help you, typically, unless you're really a late starter with that. Limits on mortgage deduction, that dropped from $1 million to $750,000. Plus, remember, they did put a limit on how much of that, not only your property taxes and that as well too, so that's a big deal. But your standard deductions increase a little bit. But if you're a itemizer, that's not going to help you. Now, capital gains taxes, assets for less than short-term capital gains, assets held for less than a year, taxes ordinary income. And then long-term capital gains have to be held for more than a year and tax at a rate determined by your income level. Now, tax is also, again, determined on income. And you're seeing here, this is your long-term capital gains. You're seeing that, if you're at the 50% rate, you got to be making less than $77,000, and you're 20%, and you see that. You can kind of read it yourself. So, and I might add, not huge changes there, very minor changes. Now, tax deferred accounts. Yeah, that was an increase of 500. That's a pretty normal increase for that. So meaning you can now put $6,000 in an IRA, or $7,000 if you're over 55 and a half. You get that catch-up provision. Now, you have an income phase out on that, so you lose some deductibility and whatnot, except if you're in a 401k, 403b, TSP plan, things like that, and you see the contributions, you're never going to retire with just an IRA. It ain't going to happen. You just can't get enough return or money into something like that. And you're seeing that with the 401k, you can get a lot more in. But you got to think about, there's a lot to think about around 401ks too. But you see the contribution limit is $19,000 or $25,000 over 55. And here's your RMDs that come along with IRAs and 401ks. You're seeing, here's a calculation. You're seeing that you have $500,000 IRA and you're 70 and a half, you got to stay taking your money. And you're seeing here that if it's basically what it comes down to, if you're making if you have $500,000 IRA and you're 70 and a half, you're going to have a RMD of at least $18,000. So, and then if you don't take it, there's a 50% penalty on top of that. So you want to take it. There's strategies around this. The other thing I'll point out, there's a law afoot that's floating around Congress right now, legislation going on right now, that they're talking about raising that up a couple of years, 72. But they're also talking about shortening, because right now, if you inherit an IRA, you can usually stretch it out based on your age. So we can do a stretch IRA strategy. But what they're talking about is shortening that up. If you inherit an IRA, so the good news is you can hang on to your money. The bad news is if you pass on your heirs, they're going to have to take all that money out in 10 years. So you can imagine if you're 50 years old and you're making $250,000 a year and you inherit a $500,000 IRA and you have to take that money out in 10 years, what's that going to do to your taxes? It's going to hurt. So if you're thinking about leaving this money behind, we need to talk. There's things you can do around that. and better things you can leave. And there's charitable things you can do too. Now, tax-free accounts. Basically, Roth IRAs have received a 500, same thing with the, but the thing with a Roth IRA, if you're making more than the dollar amount you're seeing there on the screen, you cannot do a Roth IRA. Now you can convert all you want, and I work with people with that all the time. So sometimes we put it in an IRA, or we start maybe systematic conversions over time based on wherever you are with your taxes. So there's things you can do around that. But if you cannot have a Roth IRA if you're making that kind of money, which I might argue is probably the people who need it the most. But the good news is, and we do 401ks in our business here for our business owners. And we always add a Roth option. It could be very valuable. A lot of other options we do, but the Roth option can be super valuable. So, and the same rules apply here with this. So that's something we can always talk about if that's a good idea for you. Other tax-free accounts is life insurance. Now, the cool thing about life insurance, we do this for a lot of business owners, but we do this for a lot of individuals. Especially, it really comes in handy for high income earners that can't, or higher, even moderate income earners that can't use a Roth, because there's no contribution limits. The money is completely tax deferred, and you can develop tax-free income. And when you pass, that money is going to go on tax-free to death. So none of the IRA issues that you have with life insurance, it's not a government mandated type thing. So, and if built correctly, these can be built correctly is the key. It can be incredibly important and valuable vehicles. Because again, you think about those 3 buckets of money. Again, a lot of investments, but you got these 3 different buckets of money. And I think having a good diversification amongst these and setting this up properly, you could keep your taxes reasonably low in retirement. Again, taxes could be your first or second most expensive, your biggest cost in retirement, next to maybe health care that you're going to be dealing with. Now, the importance of starting early. It's extremely important that you start planning early as possible, because there isn't one best way to take Social Security, and everybody's situation is different. They're talking about longevity and all that too. And if you're married, not married, all these different things come into play. And also remember that Social Security could be 40% of your retirement income and potentially your single most important retirement decision. You must plan on how to get the most out of it in retirement. But it also begs the question, what about the other 60% of income you need in retirement? How can you protect that income? Make sure you have protected income. Protected income, really important phrase you want to think about. Because withdrawals out of a portfolio is not protected income, because stock market corrections can really affect withdrawal rates out of a portfolio. And so you really need to think about this quite a bit. Really important, really important. So you really do need to plan for that other 60%. Because if you look at their Social Security statement, and this is what you'll see when you get that account built, get that account set up and everything, because you go in there and you go into that print there, and you're going to see, even Social Security is telling you that you will need other saving, investment, pensions, or retirement accounts to live comfortably. Social Security was only meant to be a bit of a safety net, wasn't meant to be your full retirement. But it is a hell of a benefit. Because this is what Social Security looked like for the traditional model. My dad had this model. He had a pension, he had Social Security, and he had a certain amount of savings. Now, I personally do not have this model, although I'm building my own pensions. I kind of know what to do. And I'm going to maximize my own Social Security. But this was, I get people, I had a fellow in here the other day, and he had a pension. He was an old Boeing employee. Boeing got rid of their pension. So you're seeing this model's kind of dying off. But this is great. This is fantastic. people who have this model have a much safer and comfortable retirement because they know what they can count on. So this is a big deal. Unfortunately, the world has changed a lot. Now, this is your current retirement model. It's kind of inverted or broken, because pensions are all gone, but gone or close to being gone. We'll all be receiving some portion of Social Security, but notice now there's a small amount. The amount of protected income is kind of going away. So now the trick is to sort of rebuild this. And this could be done on an individual basis because we can actually set you up with protected income, which would very much feel like a pension, along with your Social Security, and then still have the savings amount. So, because even the Harvard Business Review did an article on this, and it's saying there our approach to saving is all wrong. We need to think about monthly income, not net worth. Because my feeling is Wall Street has somehow convinced us about net worth, having this big bucket of money. What I always say is, how does Wall Street make their money? Yeah, big buckets of money. So I know from the people I work with, my clients, and that they feel so good about having regular income coming in, not worried about the machinations of the stock market, and knowing, because again, we live our whole life on income, and for most people, and all of a sudden you got to live on this bucket of money somehow, and so there's no certainty in it. So certainty is a nice thing, because it's the other factor. It's not just any income it's income that's guaranteed for the rest of your life. Because no matter how long you live, because today people are living much longer also. This graph kind of demonstrates that, because you're seeing there, the blue line is the male graph, the red line is females, the green line is for couples. You can see that age all along the bottom. This goes from 65 to 100, and the percentage of probability along the left side. And you're seeing there that let me open that up. You're seeing there that 50%. There's a 50% probability it's going to make it to 90, and a 25% probability of 94. Now, one thing I've always found kind of fascinating about that, my industry always did at age 84. Well, we've never done that. We've always planned on the rest of your life, because probabilities and life expectancy are basically a statistic. How long you live kind of what matters. But you're seeing there, I mean, you look at that, and there's even a probability of like a 5% probability of making it to 100. Now, one of the things I'll say is, if you were on an airplane and the pilot came on and said, and you buckle your seatbelt, you're all buckled in, ladies and gentlemen, this is your captain speaking. On behalf of the flight crew, let me welcome you aboard, and we should touch down in Orange County at 5 p.m. local time. I say should because we'll be experiencing some turbulence along the way and have a 25% probability rate of actually landing the plane. Now, would you actually stay on that plane, or would you be right behind me rushing out of there? Because if I heard I only have a 25% probability, I'm out of there. So we'd all be heading for the exit. Now, retiring income shortfall analysis. This is something we've developed, and we think this is gold. So we're going to maximize your Social Security benefits, because we run this report for you. So first thing we're going to do is maximize that, and then we're going to determine your protected income number. In other words, what's your current protected income number right now? So we'll first do the Social Security, and then we'll do protected income. Lastly, we'll calculate retirement income probability, which tells you the likelihood of your current plan coming true. In other words, is it going to really work out? So we're going to calculate that current probability. So you're seeing here, we'll look at your current one. We'll show you a current one and say it's 50%, and we're gonna develop a plan for you and show you what your probability of success would be then of amount of protected income. So So after this, if you choose to work with me, we will provide a solution in which retirement probability, and we do this all the time. And this has been a very valuable report for folks we've lived in to give them a lot of clarity. So I think this is to your life expectancy. In other words, the rest of your life. So, and we do this first and foremost by maximizing Social Security benefit, by which can potentially provide hundreds of thousands more income when you retire. We'll give you a year-by-year breakdown of exactly what steps you need to take for both you and your spouse. And we will work with you to determine exactly how much protected income you need in retirement and compare that to how much income Social Security you will provide, and provide safe money or tax-free strategies in order to fill the gap. We do this by breaking down your income requirements in two categories: your essential expenses and your discretionary expenses. So a good place would be to ask, what do I need in retirement? What do I want my retirement income to do? And what are your essential income expenses? For instance, right now, you live your life and you have a certain amount of your income coming in that pays your basic expenses, your food, your rent, your mortgage, your insurance, whatever the case may be. And then you have a certain amount that goes toward fund, and a certain amount goes toward retirement savings, hopefully. Now, obviously, you won't be saving retirement once you retire, so that money could now be directed toward, I call this paychecks and playchecks. Your money that you actually need to live on is your paychecks, and your discretionary, your fund money, is your playchecks. So, we want to make sure we will develop a plan for that and show you how that works. And there's an example of it. Let's say your basic expenses are $5,000, your fund money might be $2,000. So that's what we want to do, is make sure what your protected income number is. And again, then finally we calculate your retirement income probability and how much income is protected and guaranteed, and show you before and after by year-and-year analysis. This way you can actually sleep at night knowing that your money is going to last you the rest of your life and how much you're looking at here. So you'll have some certainty in retirement. Now, again, we're going to calculate this in income probability by your standards and what your lifestyle is going to look like. So we're going to work all those numbers out for you. And basically all we need, it's a simple process. We need first get an appointment, and then we start collecting all that data so we can actually run some of these numbers for you, the initial appointment. So we can email us, and we can send you this form, or you can download it. We will get you, we have a detailed Social Security Max report in 5 to 7 days, and identify strategies to maximize your lifetime Social Security benefit. Identify if you're fully retired, fully prepared for retirement. So we will do all that for you if you make an appointment, and a lot of that we'll do in the first meeting, just with the numbers, your initial information. So, and what to expect in our meeting. You will learn kind of a new way to look at money. We're big on teaching about money, so we're going to teach you a new way to look at money. We will answer the 4 most important financial questions that you really need to know, and we're going to do this in the first meeting as well. We're going to, along with all the other stuff, we're going to show you what rate of return do you have to earn on your saving investment dollars to be able to retire at your current standard of living and have your money last through your life expectancy. Remember, when I'm talking about life expectancy, I'm talking about the rest of your life, not the statistic. How much do you need to save on a monthly or annual basis to be able to retire at your current standard of living and have your money last to life expectancy? In doing what you're currently doing, how long will you have to work to be able to retire and live your current lifestyle to life expectancy? And finally, if you don't do anything different than you're doing today, how much will you have to reduce your standard of living at retirement for your money to last your entire life? So we're going to answer these 4 really important financial questions for you in that first meeting as well. Now, what else to expect from us? Now, if you schedule an appointment and meet with us, our first appointment, we will also give you a free PDF copy of our book. There's more to financial planning than financial planning. And a lot of this, we actually talk about all kinds of different planning strategies and how we look at money. And we have found that people do look at money quite differently, not only after reading the book, but after working with us, because we are big on teaching and showing people how things, not only how product works, but how money works and how to be efficient with it. Because that's really, and I'm not talking about just not spending money, I'm talking about how to spend money as well and how to save. So now, questions and comments. I hope you found this very useful. And please reach out. We look forward to comments, questions, and we hope you reach out because we will deliver on these promises that we made today. And I think you'll absolutely be enlightened on what you'll learn and happy with what you learn. Thank you very much, and we will talk to you soon. Just look below and schedule that first appointment. Thank you.